Hey everyone, welcome to the new Real Estate Talk. I usually record these interviews in person and we broadcast them later, but this is Sam Hijazin. He is one of our preferred lenders and works a lot with our buyers, whether they're buying or doing refinances. So with all the mortgage craziness that's going on and volatility, I wanted to bring Sam on and just have him give us kind of an update on what's happening and why things in the mortgage part of the world are so volatile. So Sam, floor is yours, my friend.
Yeah, thank you for having me. I appreciate it. And hi to all of your viewers and consumers. So yes, rates have been fluctuating rather frequently lately, much more so than what we would normally see on a day-to-day basis. There's a lot of reasons for it. And today I think I'm just gonna focus on three different variables. I'll be the first one to admit that I'm oversimplifying some of these, but I think this will add a little bit of color and help some of your consumers better understand some of the reasons for those fluctuations in rates. The first is hedging costs. The volatility in the equity, the bond, the treasury market contributes to the volatility in the mortgage rates, or it helps explain in part some of the rise in rates. If a lender, the example that I gave earlier, has a $100 million pipeline in the month of April, they want to make sure that pipeline doesn't put them out of business in the month of May. So what do they do? They hedge their bets. Higher volatility, deeper or bigger pipelines means higher hedging costs, which translates into higher borrowing costs for the consumer because everything gets passed down. That's the first point. The second point is supply and demand economics. We went through a period earlier this year when originations dramatically up. They went through the roof. A lot more loans were put into the pipeline than what we would normally do on a day-to-day basis, and it was taking time for those loans to be absorbed into the system.
Now, this was, sorry to stop you, but this was when the Fed reduced rates, the interest rates were really low, and the coronavirus was still kind of non-existent in our everyday life, right?
Pretty much started in the beginning of the year. Rates were relatively low. All economic indications were good. Activity was great. A lot of refis and purchases were going into the system. But the point is, a lot of loans going into the system, and they weren't being absorbed quite as quickly, simply for two reasons. One is the supply was far more than what we would normally see. And number two, a lot of banks, when the volatility did start, they started to hold on to more of their cash. So less loans were being purchased. So now you have an influx of loans, supply, far outweighing the demand. And when you have more supply than there's demand, it pushed interest rates up. To help alleviate some of that pressure, the Fed entered into the marketplace, and the Fed meeting, the one that you're referring to, which took place about a month ago, the Fed came out and reduced the Fed fund rate, which to me wasn't as exciting as the second part of the decision or announcement, which was they were going to enter the marketplace and purchase MBS or mortgage-backed securities. Now, with them doing so, that helped alleviate some of that supply-demand ratio. They basically purchased MBSs or mortgage-backed securities, reduced the supply side of things, and helped bring a little bit more stability and liquidity into the system, which helped alleviate some of the pressure that was pushing interest rates up. So that's the second point. The third point is servicing. It's a little bit more complex of an issue to discuss, but I think we'll take a little bit more time to talk about it because it's very important for people to understand the dynamic and the relationship and the different players involved in the mortgage world. Oftentimes when a borrower makes his or her payment to that loan servicer doesn't actually own that mortgage. That mortgage is owned by an end investor, a bondholder. Now, the servicer is just collecting the payment. And there's a contractual obligation between the servicer and the bondholder that even if the borrower is not making that payment, that the servicer is still responsible for sending in that interest and sometimes the full payment to that bondholder. Now, with the coronavirus pandemic and the resulting CARES Act, which was passed, it allowed a lot of people to call the loan servicers and request a deferment of their payment, 1, 3, 12 months, however. And different servicers are granting forbearance deferments under different conditions. We won't discuss that here. But the point is, you now have millions of people calling in, requesting a deferment of their payment which means hundreds of millions of dollars of interest payments that have to be made by the loan servicers still to those bondholders. So obviously, understandably, it's going to change their appetite for certain types of loans because they're going to be a little more selective as to which borrower they want to lend to. If you have a higher propensity for, not making your payment, the appetite for that loan is going to diminish, and it's going to result in increased borrowing costs for a lot of other borrowers in the form of higher rates. So, for the most part, those are the three variables that I'm discussing with people in helping explain why rates may be fluctuating a little bit more so than what we would normally see on a day-to-day basis.
And this appetite that you're talking about is, so I just saw a headline the other day that one of the, and I won't say the name, but one of the big banks just changed their minimum credit score that they would for mortgage applications to 700, for example, where it would have been 640, 660, 680, depending on the loan program. But this has changed to a minimum of 700. Is this?
Sure. Across the board, you see a lot of guideline changes by a lot of banks. Again, when we talk about appetite, it's exactly that. You look at your book of business, you look at historical data, which borrower profiles tend to default at, what rate. So, it's generally understood if you have a better FICO score or more equity in the property, you're probably going to default at a lower rate than somebody with little to no equity or worse credit. So yes, you see a lot of banks making these guideline changes in an effort to stem the tide of, people not making their payments on time.
So let's touch base on something you mentioned earlier, is the forbearance or
deferment.
What's the difference? Is this something people should do or look into, or?
Sure. I mean, I've been getting a lot of calls from past clients asking me about it. And I'll try to keep it very simple. If you are in a position where, your job has been impacted, you don't have any income coming in, you've reached the end of the road and you have no way of making that payment, definitely do the responsible thing, call your servicer, whoever you're sending your payment to, and work out something with them that gives you a little bit of breathing room to where you can make up for those lost payments at a later point in time. I want to, and I stress this to everybody that calls, a deferment of the payment does not mean a forgiveness. That payment will need to be made at a later point in time. And I can't tell you that every servicer, every bank is doing it the same, because they're not. Some lenders or servicers will require that if you were to defer, for example, April's payment, that come May, you have to send in both payments. If you ask for a deferment for another month, then the following month you have to send in all payments. So it can be a little bit unrealistic to expect people to make that many payments in a very short period of time when they're having a difficult time making one. Other servicers are allowing the borrower to take those missed payments and add them to the end of the loan. And you're just basically pushing off when the loan is going to be paid off. So I can't tell you which servicers are doing what, but as long as you are in a position and you are able to make your payment, I would definitely recommend that you do so, because it will need to be made at some point. You are, I hate to put it this way, kicking the can down the road, but if that's your only option, then that's your only option. You definitely need to call and work out a payment plan with them. But if you're in a position to make your payment and you have the means to do so, I definitely would, because the other unknown variable or factor for us is how this is going to impact borrowers moving forward that may be looking for a refinance down the road. I don't have that answer yet. I don't think we've fully figured out how that's going to work. The CARES Act specifically says that the banks cannot report those missed payments as lates, but just like you mentioned earlier, a bank changed their guidelines overnight, whether it's to increase the FICO score requirement or increase the down payment requirement on a purchase. Who's to say that they're not going to look favorably or unfavorably on someone who requested and got a deferment for those payments? I don't know the answer yet. It's still too premature. But if you are in a position to make and can make your payment, do so. And if you can't, work with your servicer.
The other thing, so to touch upon the point that you made about these payments are not reported as late, but they are reported. So on the credit report, it would show that someone is in forbearance, right?
Good question. I don't know the answer to that yet. We haven't seen any credit reports. I mean, this is still relatively new. How it's going to report on the credit, I don't know. I just know that it's not going to report as a late. Whether it shows as a payment and deferment, oftentimes, like if you look at a student loan and you're not making a payment because it's deferred up to a certain point, that verbiage reports on the credit report. So we're going to notice it at some point in time. But because this is still relatively new, I don't know of a single borrower who has gotten that deferment approved yet, and I haven't ran the credit to see how it reports. But if I was to look at it from that angle, right, how a student loan payment reports on a credit report that's deferred, usually there's verbiage that says payment deferred up until a certain date, and there's no rating, there's nothing that says that they've missed the payment. I'm assuming the same thing is going to hold true for the mortgage, but how that history is going to impact that borrower in the future to apply for any additional mortgage loans or debt, I don't know the answer yet. It's still being worked out.
I think even the lenders don't know yet. They're gonna play it by.
We're flying by the seat of our pants. Yes, this is all still very new.
All right, so people are still buying. Some people are, and I know you and I, before we jumped on the live, obviously a lot more people are refinancing now. That's where most of your business is coming from, and purchases, and that's normal. I mean, our pipeline in terms of sales is way down compared to previous years, considering this is the spring and heading into the summer market, which should be like firing on all cylinders. So if someone is still buying or they're thinking of refinance, how has the current events changed the way they should do things?
Well, let's look at it. We'll talk about buyers, okay? So, the first recommendation I would say is, get your affairs in order. As a buyer, you should have that open dialogue with your lender even more frequently now than, say, a few weeks ago. You want to make sure that any offer or rate that you are quoted is still good, is still on the table. Because again, certain product types have either been completely eliminated or there's little to no appetite for it in the marketplace. Not to go off tangent too much, but like, for example, what's called non-QM or non-qualified mortgages. Basically, any loan that the agencies, Fannie Mae, Freddie Mac, Ginnie Mae, any loan that they're not willing to insure or they don't want to have anything to do with, that loan type has pretty much been discontinued by most of the banks that I work with, most of the mortgage companies that I work with. Non-conforming or jumbo loans is what's often referred to as jumbo loans. Again, these are loans that Fannie Mae, Freddie Mac, Ginnie Mae don't insure, don't have anything to do with. So that marketplace, that secondary market has shrunk quite a bit. So those loans have been impacted quite a bit. So there are certain product types that have been impacted. Others are still fine. If you are a cookie cut, conventional loan, conforming loan, rates are still extremely low. We're still in the threes, mid to low threes, depending on your situation, obviously. So if you're looking for a refinance, talk to your lender, have them do the analysis of, what your savings would be, what the cost is, et cetera, et cetera. And if you're buying, I always tell all of the clients that I work with when they ask me, is this a good time to buy? I always say, if it's a good time for you, then it's a good time to buy. Focus on that one constant, which is your monthly payment. I always tell the story of the very first house that I bought when I was in my 20s. I was upside down on it for 15 years. But that one constant that I focused on was that monthly payment, because I knew no matter what, if I had to go go bust tables at a restaurant or something, I knew what I could make every month and I knew what I could comfortably afford. And that stuck with me throughout my tenure as a mortgage broker. And I always relayed that to the person sitting in front of me when I was qualifying them. I always tell them there's always going to be ups and downs. There's always cycles, ups and flows in real estate. And that's fine. But if you focus on that one constant, that monthly payment, in the long term, real estate has done me well, has done a lot of your clients well. It's still a great asset class. It's still a great investment. But focus on the monthly payment, and then everything else, just all that white noise will get drowned out.
Okay, perfect. And so I guess the same would qualify for if someone's looking to refinance, right?
Definitely. Like I said, the bulk of
situation depends on anything's changed in terms of employment, all that.
Well, if you think that there's going to be any changes to your employment and to your income, seriously consider if it's the right time to do anything, whether it's to buy or refinance. And that's a conversation, an honest, open dialogue that you should have with the person that you're working with. But as far as the bulk of, look, I'm busier now than I've been almost at any point in time in my career. So that's with all of the volatility and all of the craziness that's going on around me. So there are still, loans to be made for a lot of people. It still makes sense for certain people to buy, still makes some sense for certain people to refinance, for some people more so than others. So again, for the bulk of the clients that I'm working with, those agency, regular, conforming, cookie cut, 30-year fixed mortgages, rates are still at all-time lows. So have that conversation with your broker or lender. You're welcome to call me. We'll always have that open conversation. There's no pressure ever. I'm plugging myself in here, Kareem. But, we'll discuss your current situation and what you would potentially gain by refinancing. And if it makes sense, we'd love to help you. And if not, I feel good about the prospects for low rates for the foreseeable future. I know there's a lot of anxiety and a lot of angst, but I think once we get through this, and we will get through it, we should be enjoying lower interest rates for the foreseeable future.
Okay, and in terms of, I guess this is more for buyers than it is for someone that's looking to refinance, but turn times, are you still doing, is the regular escrow still 30 days or are things taking a lot longer? Appraisals also, same thing. How have timelines been affected?
Things are taking longer across the board to get done. I have some of the banks that I work with that are taking, several weeks before an underwriter even gets to a file, where before we were expecting them to be reviewed in a matter of days, now it's taking weeks. So, it's always wise to set the expectations, realistic expectations early. It may not be what people want to hear, but if somebody's looking to buy and they're requesting to get a loan or a transaction done in 20 days or 21 days, I'm probably telling them it's going to take close to 35 to 45 days, realistically. So can it get done sooner? It depends on the investor's turn times. But across the board, generally speaking, it's taking a little bit longer to get a loan done today than, say, a few weeks ago. Yeah.
Okay. And yeah, I guess that answers that also. Okay. Anything else you want to share, or I guess final announcements?
I think that obviously be safe out there. But I said it a few moments ago. I know there's a lot of anxiety out there, and it's understandable. But the bulk of buyers should not, discount the idea of buying completely. You have to look at your situation and make sense of things for you specifically. If you are secure or safe in your job, if you are finding a property that has that check marks and it's in the price point that you're comfortable with, and more importantly, you're getting that monthly payment that you know that you can afford long-term, don't discount the idea of putting an offer on a property. I think you would be doing yourself a disservice. And if you're in a high interest rate type loan, or if you think that there's a potential for you to refinance and reduce your payment, now is as good of a time as any to call that person that you're working with. It doesn't have to be me. Call your broker, call your lender, and talk it over and see if there's a way for you to reduce your monthly payment, because again, they are at all-time lows.
Perfect. Yeah, to touch on the last point, I was just talking to a buyer yesterday, and I referred them over. They talked to you briefly, but you're right. It's all about, is the time right for that person or not? It's not about the market. It's not about anything other than them, their circumstances, and their payment, their monthly payment. Because in many times, people don't think of it this way, but it is absolutely true. Rent is just money that you throw away every month. And I tell people, you have a mortgage, whether it's called rent or mortgage, it's a mortgage, because everyone needs to live somewhere. So does it make sense to buy or to rent? There's a lot of factors that go into it, but essentially it's a personal decision based on their circumstances. Doesn't matter what the market's doing.
again, focusing on that one constant helps drown out all of the white noise. If you have a very long-term horizon, if your perspective is 5, 10, 15 years, then everything that you're experiencing today, you'll probably forget, that far into the future. So as long as it's an affordable, as long as it's the right property for you and that mortgage makes sense for you and you can afford it and it fits your circumstances, then yeah, you should definitely continue to pursue buying. I would be a buyer over a renter any day.
Let me ask you something before we end real quick. Investment properties, has anything changed in terms of guidelines, down payments, anything that's going on, or is it still the same?
Well, some banks have their own overlays above and beyond what Fannie Mae and Freddie Mac, for example, would allow you to do. For example, as far as the down payment and the FICO score requirements, generally that has not changed. You will see some increased FICO score requirements coming about, I think, here very, very soon. Currently, you can have a 620 FICO score and apply for a conventional loan, even an investment property. The pricing may not be very attractive, but you can. You're going to start to see some increased FICO score requirements, not necessarily because Fannie Mae or Freddie Mac is putting them in place, but because, again, the banks are putting their own overlays simply because they're looking at past performance and they're seeing that certain loans, certain buckets perform better than others. In the case of investment properties, if I have two properties, one is the one that I live in as my primary and one is my investment, and I'm impacted financially, if I lose my job and I can only afford to make one payment and my tenant is not making the payment, so I don't have that income stream coming in to cover that mortgage payment. Obviously, I'm going to focus on and prioritize the mortgage that keeps a roof over my head. It makes sense, right? So some banks we're seeing are including guidelines or overlays that require that you have a little bit more in reserves for an investment purchase, which makes sense to me, a little bit more of a cushion. So that way, if something like that does happen, you have more money to tap into to keep yourself going in this crazy time and to continue to make your payments on time. So those are the types of changes or overlays that we're starting to see with some banks, and we'll probably continue to see them for the foreseeable future. But, we're going to have to look at it case by case, file by file. But as far as the agencies themselves, they haven't imposed anything as of yet. The guideline changes that we're seeing are overlays by the banks and seeing what appetite they have and don't have for certain products.
Cool. Thank you so much. I appreciate all the time and wisdom and everything. Feel free to reach out to us or to Sam directly if you have any further questions or have any advice on the lending side of your world. Stay safe, everyone. Sam, thank you so much.
Thank you very much. Stay safe and hope to connect soon. Take care. Bye-bye.